Stock of the day though, one I picked that's in the news, I thought Ampol would be a good one to talk about. It set its sights on record annual earnings, citing improved performance of its non-refining divisions. This as it reports a 10.5% drop in margins at the Lytton refinery in the fourth quarter on higher crude premiums and supply disruptions due to the geopolitical tensions. Country's top fuel retailer recorded refinery margin of $10.52 a barrel, down from $11.76 a barrel a year ago. And of course, it's our biggest retail petrol distributor, but also what makes it unique is the refinery as well, which it gets a fair bit of government assistance for because it's a strategic asset. Howard, what do you think of Ampol's update?
I thought the update was good, but I mean, it's hard to get enthusiastic about this company because it'll have one good year and then a bad year and then a good year and then a bad year, and it's totally unpredictable, largely dependent on what's happening in the world oil market, and that's impossible to predict. And of course, the refining business only survives because it gets government assistance. It wouldn't be a good business without that. So, its earnings have grown at 1.8% a year over the last several years on average, if you look at the compound annual growth rate. And that's slightly less than inflation. So certainly not going to be a wealth winner, but nor for that matter is it a capital killer. So the time to buy these kind of stocks when they bounce around like that is only when they're really cheap. And it's certainly not very cheap at the moment. I mean,
look at that 5-year chart. It's just coming off a 5-year high.
Absolutely.
Which, for those financials that you just listed,
absolutely,
you wonder why would it be there?
Quite. If you want to buy this, you want to buy it when it's just had blood in the streets kind of thing. One of those on the graph there, one of those times when it's really low.
25, $27.
You're never going to pick it exactly, but if it got to somewhere in the mid-20s, you start saying, okay, I could at least trade the stock in that I'll sell it again one day in the mid-30s, but you wouldn't be buying it from a point of view of wealth for now.
If you were in it, would you keep holding it?
Well, I definitely wouldn't be in it. Right. I don't think any TeamInvest members would. But no, not at those prices, because I'd look at it and say, it's near its high PE, it's near its high price.
So if you were in it, you'd say, sell it.
Yeah. Buy it
You've
back
had a
again.
good run.
At some stage in the next couple of years, you'd probably buy it back at 27 or something.
Right.
You've got rid of it at 35.
Yep. Grady?
I agree, actually. It's sitting at a 5-year high right now. You're paying a PE of 66 times, and so it is expensive, and earnings is slowing, as we know, in the oil front. But the interesting thing is that they're making a lot of their revenue from their foodery business, so the high margins they make on the food and the convenience.
So the convenience store of
the petrol station.
Right.
So looking at the announcement out today, they said a lot of they're expecting record sales from the retail business. So if you think about it, if you feel like a Magnum, you can get a Magnum for, I think it's $8 now at the foodery, which is just insane. But when you want a Magnum, you want a Magnum. So
$8?
Honestly, I think I'm close. When I went the other day, I looked and I was like, this is insane. This is inflation times a million.
Here's the thought. As there are more electric vehicles, will you drive into a petrol station to buy a Magnum for $8?
No, I'll be going to Woolworths for 2 packs of Magnums for $8. So, but the thing is that their diversification out of just solely petrol is really smart because, as we know, the EV movement is ramping up. We've got a lot more cars on the road are EV now. We're expecting sales to be through the roof for EVs over the next years. Companies and countries are phasing out petrol cars, so this company it's got a lot of headwinds coming its way in that front. So the diversification strategy now is really smart. So I would take profit right now because it's sitting at a really good level, a higher PE.
So you do sell as well?
I do sell.
Would you sell all of it or just take profits off the top?
I'd probably take the profits off the top.
Right.
Yeah.
Okay.
So keep your initial.
So taking profits is sort of 30%. Is that what you use as a rule?
My rule is I take out my initial investment and leave the profits to run.
It's what you do when you can't quite make up your mind.
Right.
That's what I did the other day. I sold some of my investments, Niren sold my initial deposit, and now it's just running on profits.
Yeah.
Because that's been on a serious run.
Right. Which one was that?
Niren.
I
bought in at 13, now it's 23, and I was like, see ya.
Yeah. But I suppose, Howard, when you don't know what to do, you take your profits. But when you sell a stock, in the back of your mind is, what if it keeps going higher?
Of course.
Absolutely.
Fear of missing out and fear of losing out
Yes.
are two enormous motivations. But what you've really got to accept in the end is you really only want to hold about 20, maybe 25 companies in your portfolio. And you're aiming to have the very, very best ones you can. It's a bit like I always, and it relates to the sort of thing you do as well. I think about an AFL team. You're trying to identify the best possible players that you can manage to have on your list within your budget that you can afford, and cap that you've got to spend, and the draft picks that you've got. You don't say, oh, well, I'll keep a few others just in case.
No, because when you trade a player somewhere else, you hate it when they play well. Should I have kept that?
Exactly.
It's the same thing.
Absolutely. And this is the psychological problem we've always got to get over with all choices we make in life.
So I have in my little self-managed super fund, I have a watch list of all the stocks that I have on it. When I sell a stock, it goes off the list.
So you don't want to know.
I don't want to know what it does in the future, because I find it emotionally sort of stressed.
It is. I honestly get stressed about these things now. Other
So I just don't follow
small
them,
life
then.
issues used to stress me out. Now I get stressed about my watch list.
But often I get reminded here on the call, I go, oh gee, I did sell that a year ago. But anyhow,
we always say that
investing.
we're aiming to get 85% of our decisions right.
Right.
Now,
85?
Yeah.
Jeez,
Now that's a hell of a lot better than flipping a coin. And
yeah.
we can do that because of the software we've got and our whole methodology.
Yeah.
But even with 85, it means 1 in 7 of the decisions you make, you're going to regret 5 years later.
Yeah.
So accept it. That's the way it works.
Yep.
But if you're getting 6 out of 7 of them right and 1 out of 7 of them wrong, you do exceptionally well with your portfolio. Your returns are superb.
I'll take decisions like my Niren decision any day.
Yeah. Which it's like buying a house that's gone up. You only talk about those to your friends. You don't talk about the ones that have gone down.